As governments across Australia continue to consider infrastructure asset sales, as well as grappling with the development of a growing list of major infrastructure projects, Deloitte Australia has brought back from the UK one of its most experienced corporate finance partners, James Riddell, to lead its infrastructure M&A practice across Australia and Asia, supporting financial investors in this asset class. TFI-News met with James prior to his departure from London to discuss and review the European market. And first question up focused on the current appetite for infrastructure assets from public and private pension funds.
I think the appetite is actually quite strong. There have been some very large transactions that have happened over the last 18 months, 2 years. I think there's a significant amount of equity capital available in the market at the moment. So you've seen some very large transactions, OGE in Germany, Edinburgh Airport here in the UK, the gas-led asset transactions that have happened in Norway. So there's been some very large transactions, and in fact also very large amounts of debt raised associated with those transactions.
And where's the investment flowing to? You mentioned those sectors. Is it mainly energy, transmission networks rather than transportation-led projects?
No. I think there's still a big appetite for both energy and transport infrastructure. Edinburgh Airport is a good example of that. But I think what I've really seen over the last 2 years or 18 months has been a shift away from a geographical focus. So there's been a massive shift away from Southern Europe, away from Iberia, and focusing on assets that are coming to market in places like the UK, Germany, France, and the Nordics. Whether that's perceived less risk in terms of currency or what that may mean for the currency going forward, but certainly less perceived political risk.
And in terms of the UK now, the HM Treasury has been working on the pensions infra platform, PIP. Do you think that's going to be the optimal platform to attract public sector pension fund money, or should you look at a more IFM Australian-led model?
Look, I think the model actually doesn't really matter. How they actually invest is really, it needs to be a structure that suits the underlying investor. Whether you go through a managed fund type IFM model or whether you're a series of alongside direct investors doesn't really matter. The key thing, and I think this is the bit that people are missing a little bit, is for pension funds to be able to directly invest in infrastructure assets, it needs to tick the boxes for them. And one of the key boxes for pension fund investors is running yield, is the ability to derive a yield return from day one. So trying to earmark pension fund money to develop new infrastructure, which have lead times of 3, 4, 5 years of construction, is just not going to work. It doesn't meet their key criteria in terms of their investment model. They have long-term pension fund liabilities they've got to fund, and the only way they can fund that is by investing in assets, securities that give them yield to enable them to do that. So in terms of pension funds investing in brownfields or secondary infrastructure assets, the structure doesn't matter. I think the appetite is absolutely there. I think the UK pension funds in particular have probably been a little bit slow to move, but when they do move, they'll make the Canadians look quite small in terms of their investment power. So I think they're very keen to invest. I think a lot of the trustees are looking at alternatives, and particularly infrastructure as a good investment strategy for themselves. But how we package up, or how pension fund money is packaged up to assist in the development of new infrastructure in the UK remains to be seen. I think the PIP model is more along, or is definitely skewed towards a debt type model where they provide debt finance, and that does tick that box for them where they receive an interest yield day one, regardless of whether it's in construction or operation. So I think the government and other parties need to understand what drives the pension funds, and the appetite for investment in infrastructure is absolutely there. The willingness to to undertake transactions is absolutely there, and the availability of capital is coming on stream very, very quickly.
You say models don't matter, but looking at sort of the way the infra model has developed and level of fees charged by fund managers, and as banks have exited funds and some banks have launched new funds such as Lloyd's. With your time in London, how have you seen this develop?
When infrastructure first started up in Europe, it was very much modelled on the PE model. So the funds tended to be reasonably high management fees, 2.5% was the norm, with carry structures that were very similar to the private equity carry structures. 20/8 models where the fund manager would derive a very large return on their ability to monetize the asset after looking after it for X number of years. That model doesn't really work for infrastructure, and the market worked this out, and the investors worked that out. And I think what you're seeing is a lot of the second and third generation funds, regardless of whether they're independent funds or continue to be investment bank backed funds, have adjusted with the market. So management fees have come down because, fundamentally we're talking about assets that have that don't have huge amounts of growth. They're stable long term. They have secure cash flows. They're either regulated assets or underpinned by contracts. They're very asset-backed assets, very, very capital intensive assets. So, your ability to derive huge amounts of revenue growth or EBITDA growth just doesn't fit with this model. So carry structures have changed, management fees have come down, and I think a lot of that's to be competitive with direct investors saying, well, should I invest through a fund manager, or should I just build my own team and invest directly? And I think the market's sort of got it about right now. I think there definitely is a place for managed funds. Some of the skills they've got and some of the people they've got are first class in terms of managing infrastructure assets, and I think a lot of the pension fund investors particularly see that.
You're heading back to Sydney in a new role at Deloitte. Just give me a few words on what that new role will be, and also where you see now the Australian and Southeast Asian market for infrastructure heading over the next few years.
Well, it's my role is twofold. One is I'm taking a sort of global oversight role for infrastructure M&A, and that's really about developing our strategy in terms of how we serve our clients. I think we've got a very strong business here in the UK, which will continue to flourish. We're in the midst of building up our practice in North America. And so basically what I'm looking for is sort of a 3-hub strategy to serve our clients globally. The Australian market and the Southeast Asian market are slightly different parts on the life cycle. Southeast Asia, if we just cover that quickly, I think where Southeast Asia is at the moment, a lot of the infrastructure development that's happened over the last 5 years has been financed primarily by governments and or state-owned enterprises who have literally just been writing checks to build water utilities, gas pipelines, electricity transmission, airports, ports, roads, etc. And I think what you'll find, particularly if there is a slowdown in GDP growth in Asia, that there will become a tipping point where the governments will start to say, maybe it makes sense for us to try and recycle some of that capital and encourage foreign investment to come in and buy the existing infrastructure that we've built over the last 5 years and are operating well, so that we can use that capital to continue to develop, to continue to build new infrastructure. So I think that point, it's not here yet. I think it will come, and I think it will come very, very quickly. And I would not be surprised to see a big shift in terms of capital allocation globally from the investors towards that region. In terms of Australia, I think Australia's has really got sort of 2 M&A markets in the sense that there's continual development of new infrastructure, a lot of it linked with the mining sector, where the big mining companies need to get their product to market, so rail networks and port networks are being built, and associated with that you're building electricity transmission networks, etc. So those assets are being financed. The mining companies, the big global mining companies, are looking at ways to finance those. Looking towards financial investors is probably not going to work in the near term, but certainly those assets, once they're up and running, will become fantastic assets for financial investors to look at. We've got government in New South Wales that are planning to privatise electricity transmission assets, which will create a good amount of deal flow. The other area in Australia, I think that there's an opportunity for investors is there, and this sort of comes from the original or the groundbreaking Macquarie model of the late 90s, early 2000, where they were buying up infrastructure assets and putting them into vehicles that were then IPO'd. And so the Australian market's quite unique in the sense that it has a number of single asset infrastructure funds that are listed on the Australian Stock Exchange. And they range from energy infrastructure assets to transport infrastructure. You've got single toll road assets, you've got single gas pipelines, single electricity transmission assets, all in separately listed vehicles. And I think one thing that the capital markets has demonstrated from 2008 through to today is it doesn't really understand this sector. It has incurred very similar volatility to the rest of the capital markets, to the rest of the listed markets in terms of share price, which doesn't actually fundamentally make a lot of sense because the underlying assets are pretty stable, secure assets. So I think there are opportunities for financial investors to come in and take some of those assets private over the next few years, particularly when refinancings come up and other pinch points in terms of their life cycle. But I think there's lots of opportunity.
James, thank you very much. Thank you.
Thank you.